Alright everybody, this is Naren Andrews with my presentation on day trading options. A little disclaimer for you guys. Please read it. I am not responsible for any gain or loss that you experience in the markets. This is all up to you. This is a complete skill development endeavor for you to get better at entries and exits, and for you to possibly make money. The only thing I am certain about in trading is that I am going to protect my capital. That's it. We can take positions based on probabilities of market direction, but it's never about the money. It's always about the win. So here are my trading rules. Protect your capital. Cut losses quickly. If you aren't profitable soon after you enter the trade, you're likely wrong. Okay? Now, the result of a good trade is a profit. Okay? If you jump in, you should see green very soon. If not, then clearly you're in the wrong position. And you need to get out. Always, always, always protect your capital. This is a business of preserving what you have and making more on it if possible. That's it. Enter as close to support and resistance as possible. Smart money enters here and sell to buyers once the move is underway. We look at that a little bit more closely when we get to the charts, but support and resistance entries allow you to capture most of the profit, if not all of it. Trade for the win, not the money. Again, this is about skill development, right? If you make money, great. If you take a small loss, that's still a win because you're preserving your capital. Do nothing unless there's something to do. Patience is key. Do not jump into this market thinking that you're automatically going to make money or you're automatically going to be profitable. Everybody loses money. Not everybody makes money. But if you are able to cut your losses, right? If you only make profit 60% of the time, you'll still be ahead of the game. Keep it simple. Don't overtrade, don't chase, don't get emotional. You have to take the emotion out of trading. Keep it as mechanical as possible. So this is the daily process, right? Trading is very, I won't say predictable, but it's very repetitive. Okay, the market only goes three ways. It goes up, it goes sideways, or it goes down. Your job is to figure out the right direction and plan for it and execute. That's it. So the first thing that we do every morning or whenever we do trade, we determine likely market direction, plan for both directions. Secondly, we scan for pre-market activity by volume to identify stocks that are moving big for potential plays. Pre-market is a good indication of where the stock might be heading or what the sentiment is on the stock. Okay, if we have a big gap down, then we may be bearish. If we have a big gap up, we may be bullish. But once the market opens, you have to expect the unexpected. The market can turn at any time, and it doesn't care where your money is, right? It's your job to read the market and be prepared for it and to take advantage if it goes in your way. At market open, chart top 4 names in line with market direction after macro and micro analysis. Okay, you don't want to try to focus on too many names. It gets confusing, it's hard to follow. Some people do it, But if you can be right on one or two trades and be efficient, that's all you need. Don't try to pay attention to 5 or 6 different stocks. You'll end up chasing moves, getting in at the wrong time, and just making bad decisions. Now, step 4, identify the best setup for a strong directional trend and enter a trade. If there is one, if there isn't, just sit the market out. There are 20 trading days a month. Okay? You're trading options, you're not trading stocks. And so the amount that you can make within this 1 month is substantial. You don't need to trade every day. You don't have to trade it every day. Some people love it because this is kind of a sport. It's fun. It's challenging. But patience is key. So time frames. All right. Macro and micro time frames help us to identify price action and trend and potential moves. All right, so always chart multiple time frames. The 1 minute, 5 minute, 15 minute, and daily are ideal. So you're looking at a chart and you want to have a good perception of what's happening in the chart, what's happening in the direction, where is it going. Are we gapping up? Are we moving sideways? Are we really gapping down? Or is it just a small pullback? Here are the charts. These are charted for Morgan Stanley. Here you have the 1 minute, you have the 5 minute, you have the 15 minute, and the daily chart. With the 1 minute, you can see you have all this noise right here, this up and down activity at the first part of the day. But if you look at the 5 minute, it kind of smooths things out for you, so you can get a clear direction. You can obviously see that it came down here, or we're actually on an uptrend here. But if you look here on the 1 minute, it seems like we're down, then we're up, then we're down, then we finally moved up, and now we're down again. Caught some support here, moved up, and now we're finally down. But time frames help you to better see where the direction is heading in the price action. And you definitely need that when making your decisions to enter or exit a trade, right? Because if I entered here at the top on the 1 minute and I see that we're coming down, right? We caught some support here and we're moving back up. If I see this bounce here, I may think, well, maybe I need to come out because we're obviously headed back into an uptrend. But if I look at the 5 minute, it doesn't look that big, like that big of a move, right? So based on the 5 minute, I would have stayed with the trade and captured the rest of this down move here. Now the smaller time frames are used for day trades. Okay, the daily is actually used to identify the macro trend in the stock. Okay, we can see that we're coming up today. We got a nice bounce today, but overall we're on a huge downswing over the past, what is this, eight or 9 days. So this is important to see. And then this tells us that we're obviously bearish on the name. So we could very possibly see some more downside, even a crack below this level here. Okay. I also like to pan out on the 15 minute to get a even better idea of where we're heading. Okay. We'll use our trend lines to kind of mark the trend, right? Just to keep things in perspective, in case the trend line gets broken, then more than likely we'll see a move to the upside. All right, so the ES and VX futures. All right, the ES is the S&P 500 futures. The VX is the volatility index. Okay, these are used to determine market direction, and this is where we'll be dependent for the probability of the market trend, overall market trend, right? They run counter to each other, so when one is going up, the other's going down. A strong VX indicates market weakness. A strong ES indicates market strength. Now in today's market, today is the 13th, you can see that our VX is actually down pretty big. We're currently down 2.89%. Okay, we were heading downward overnight, and once the market opened up at 9:30, we took a big dip to the downside. Right now, looking at the ES, futures, there we go. Looking at the ES, we see the complete opposite. Remember that these run counter to each other, right? So we ran up overnight, and once the market opened up at 9:30, we had this big run up, right, pushing most of the stocks up. Now, in addition to looking at the ES and VX, we also want to check our advanced decline line. Looking at this, we can see that we have 326 or 27 names advancing to the upside, and declining, we have about 170 names declining. Pretty bullish market, right? And so we'll end up seeing a lot of names gaining in value. Sort this by percentage gain. All this green, right? So most of the market is green, and we're in an uptrend. And you could look at, just kind of scan through these names to see what the trend is. This was from yesterday, a big 5.75% run up from yesterday's close. Run up here on AYI. I don't know what that is. Big run up here. A lot of stocks are making moves to the upside, which is great, which is wonderful. And the great thing about options is that we can play both the upside and downside. We can play this sideways action too, by using what we call spreads. I don't use them because spreads actually limit your potential profit. Buying puts and calls actually gives you unlimited profit potential. I like that better. All right, so the strike. The strike is a price that you expect the stock to hit for your option to be considered in the money. Okay? The closer we get to the strike price from your entry point and through the strike price, the more percentage gain you will make. Okay? Now, you have to be as realistic as possible when choosing a strike price. All right? The further in the money you go, the more expensive they are. Okay? the further out of the money you go, the cheaper they are. Right? Now, if you go way out the money and your stock magically hits that strike price, that's way out there. Say the stock is at 140 and you choose a 180 strike price. If it for some reason hits that strike price, you will gain quite a bit. I'm talking about probably 1,000% gain, 2,000% gain, some ridiculous number. But the likelihood of that happening is, yeah. I'd rather you stick to at the money strikes, which is the next strike to be hit, or one out of the money strike, which is the second strike to be hit out of the money.